Hey folks, in this video we'll try to know about a new asset class that has been launched by SEBI, which is SIF, Specialized Investment Fund, which is quite similar to mutual fund, but there's a subtle difference which we'll learn in this video, right? So good thing is, thankfully, the tax structure has been kept the same as mutual fund, so it's going to be less of a headache for retail investors, right? So first of all, why launch SIF? What was the gap? Right, so there wasn't an investment product available for retail investors which used a complex strategy, right? We did have it in the form of AIF category 3, but it had an investment amount of 1 crore, so it wasn't really a retail focused product, right? So there was indeed a gap to fill. Now there is a lot of hype around SIF because it's new and there isn't a lot of clarity around it. So that's what we'll do. We'll try to build some clarity around this product, and we'll see for ourselves if it makes sense for us and if it's actually worth the hype, right? So first of all, what's so special about SIF? What makes it stand out? Right? The added feature for SIF is that it uses a long short strategy, whereas mutual fund is a long only product. We'll learn these concepts in this video, and the thing is, only mutual fund houses can currently launch SIF products, which means if you and I want to launch an SIF, we can't. We need to have a mutual fund license first, right? So like mutual funds have categories, SIF are also going to have categories, which cover equity, debt, commodities, derivatives, REITs, InvITs, and whatnot, right? So a small thing to note here is that as per the latest guideline, REITs now come under equity and equity associated products, right? So that's a small thing that we need to keep in mind. Now the minimum investment amount for SIF is going to be 10 lakh, and once the investment amount is reached, we can do SIP, STP, SW on top of it, right? Cool. Now before we proceed further, we must know what long short strategy is. So we discussed earlier that mutual fund is a long only product, right? Now what is long strategy? Long strategy basically refers to buying a security whose price we think will go higher. So I make money when the price of the share I bought goes up. Just the buy low, sell high kind of strategy. Pretty straightforward, right? Now shorting strategy is the opposite. It means sell first, buy later. So I sell something that I don't have, and after a fixed time, I must buy it to square off my position, right? So I do this when I think that the price of something of a security is going to go down, right? So I'm able to make money in a falling market as well. Now, long short strategy is basically a combination of both. I can go long in some stocks, I can go short in some stocks. This strategy also gives me the freedom to go long and short in the same stock. So let's say uh, a stock is in a structural bull run, right? I know it's going to do well in the next 2-3 years, but for the next 1 month, I see Trump has laid out a tariff, so the next 1 month is going to have headwinds. So what I'll place a simple short position for the near term, right? So that's how I can make money in both falling and rising markets. And like I described, we can go short and long in the same stock as well. Now we'll see what is the value add that shorting brings to the table, right? So first is quite obvious that I get the opportunity to make money in sideways and falling markets. Now you might ask, how is it possible to make money in sideways market, right? So let's say there is a stock which is range bound. It goes from 100 to 120 and then comes back to 100, right? So and it has done this multiple times. So let's say the next time it goes to 120, I'll place a short position, and when it comes back to 100, I make money in that journey, right? So the second advantage is again quite obvious, that it provides enhanced diversification. I get to make money irrespective of the overall market direction, right? So if the market is going up, if it's going down, or if it's going sideways, I get to make money in all three scenarios, right? And also by design, it must have lower beta than long only products, because I have a feature for capital protection in the form of naked shorting, in case of falling markets, right? And now for its cons, right? So one more variable added to the equation means one more potential point which I can screw up, right? So the SIF performance is going to be highly dependent on the fund manager's ability to make the right calls. The fund manager must make the right long calls and the right short calls as well, right? So you might argue that this is the case for mutual funds as well, right? That the fund manager needs to make the right calls. But in SIF, there's a whole new aspect that Indian mutual fund houses have not seen so far, right? The thing is, wrong short calls can also cost me money, and that's why, since it's a fairly new strategy, SEBI has capped that SIFs can have short position only up to 25% of their overall holdings, right? Well, a minor con of SIF is that it's going to have a higher expense ratio than mutual funds. So we'll now see how SIFs and mutual funds differ, right? So first obvious difference which we've earlier discussed is that that SIF is a long and short product, whereas mutual fund is a long only product. Now it's important to note that mutual funds can also hold put options and they can hedge their holdings as well, but they can't do naked shorting, right? So the next thing is, like we've already discussed, SIFs can make money in falling and rising markets both. But for mutual funds to make money, I need to ensure that the holdings I have must increase in price, right? Um, Both products are targeted to retail investors. So, and since the minimum investment amount is going to be 10 lakh, which is not the case in mutual funds, it also is a HNI focused product along with a retail focus, right? Thankfully, the taxation is the same. 12.5% LTCG on top of the exempt limit, and if we sell within 1 year, we must pay 20% on the profits as short-term capital gains. Now the investment universe is exactly the same except for the shorting strategy, and and the reason why I'm calling SIF as a conservative product compared to mutual fund is that I have a additional feature to protect myself in a falling market, right? So by design, it must have a lower beta. Now we'll see what categories of SIFs have been launched. So there are total 7 categories. 3 of them are equity oriented, 2 are debt oriented, and the remaining are hybrid oriented, right? So for the first equity oriented category, we have the all cap product, where where we must deploy 80% of the capital in equity, and 20%, 25% shorting is allowed. So this is basically a flexi cap product, flexi cap equivalent to mutual funds. The next category is equity X top 100, which means I must invest 65% in mid and small caps, excluding Nifty top 100, right? And here as well, 25% shorting is allowed. In fact, 25% shorting is allowed in all of the categories, right? And the third equity category is sector rotation long short, where I can invest in as much as 4 sectors. Now sectors can be automobile, it can be chemical, it can be let's say banking, and it can be NBFC. I just named 4 sectors, right, randomly. So and here as well, 25% shorting is allowed. So and it is important to note that if I have 4 sectors, I cannot go long in 3 sectors and short 1 sector. The shorting is allowed within the sector. I must go short in a sector which I am largely long in, right? So that's the condition. We'll skip debt oriented because I think in debt we must not we must keep things simple. So I think we'll skip to hybrid. In hybrid, there are again 2 categories. There is one hybrid long short, where which is kind of a balanced advantage fund kind of product, where I must keep 25% in equity and 25% in debt. The remaining I can keep anywhere. And the final hybrid category is the active asset allocator, which is the most flexible and also the most interesting category because it gives full flexibility to the fund manager. If the fund manager wants, they can go up to, let's say, 80% equity. If they see opportunity in commodities, they can go as much as 80% in silver, 80% in gold. If they see no options available, they can go 80% in cash as well. So it's the most flexible product out of all seven, right? And it's a mandate that each category must have 2 days withdrawal frequency. That if someone who has invested wants to withdraw their money, they can get 2 weeks, 2 days in a week that they can do so. Now we've already gone through most of the risks associated with this product in the previous slide, so we'll go through this quickly. The first one is obvious. I have a heavy dependence on the manager's ability to make the right calls. Second is, if I make a short call and it goes wrong, I can lose money in that call as well, right? Third is that it's not a simple product. It has a new variable that Indian mutual fund houses have not operated upon, and it's important for investors to know that in a good market condition, since it by design it is designed to give a lower beta, so it by design will also underperform pure equity mutual funds, right? Also, we don't have a track record for SIF. It's a fairly new product, and there is no performance record for SIF. Although we have a very similar product available in the form of AIF category 3 as earlier described, but it's not very transparent, and we don't have data available for AIFs much. But from what I've seen, it's the AIFs do not have a superior outperformance compared to mutual funds. They are very much in line, right? Yeah, so to conclude, SIF is basically a new product which has a small feature on top of mutual fund, which is naked shorting, and a variable introduced in the overall equation can become a variable that I can screw up as well. So that's something that we need to look out for. And since by design this is a lower beta product, um, we must it's better that we combine it with a long only product as well, right? So that the overall beta becomes lower than the overall market, and I get superior risk adjusted returns as well. Well, since it's a new product, we should also wait and watch to see how the Indian fund houses are adapting to this new product. And um, uh, and another thing is that SEBI has already clarified its intention that this product is not meant for beginners, because they have set the minimum investment amount as 10 lakh, right? So that's all I have for this topic, and thank you for staying and watching till the end. Thank you.